Hey guys, hope your day is going well. We're popping on to talk a little bit about the structure of the income tax return. Primarily, what we're going to talk about is taxable income because I think it's something that maybe if you haven't spent the time to go through an actual tax return, you might not quite exactly know what it is we're talking about when we're talking about income. And the corollary to that, which is the part that excites me, is how do we make that income smaller, right? How do we use the tax code to our benefit? What does it look like? What are we adding? What can we put on our return legally, of course, like we're not making stuff up, but what can we do to bring that taxable income down? And I think the first step is to figure out what actually goes into it. So let's get started, right? Hi, I'm Bet Hochberger, CPA, CGMA, and today we're going to dive a little bit into what is taxable income, right? So what are the elements that make up your taxable income? How do we go through that calculation? And I thought the best way to do this would be to take a look at an actual tax return, right? This seemed like, to me, it made the most sense straight from the source, so to speak. So if you're looking at this is a 1040 or an individual income tax return. This is what most, if not all, definitely not all, but many humans will be filing. So there's a lot of administrative stuff, name, status, blah, blah, blah. If we come down here to this area where it says income, right, we're going to start seeing what are the elements of income. Probably one of the most common, W-2s, right? If you've got a day job, you got a W-2, and that's where that information goes, right here in box one. I'm going to ignore some of these things for the moment because they're kind of related to that, to W-2s. Then if we get here, line 2, tax exempt interest, taxable interest. Now you'll notice that tax exempt interest is floating over here because it's not part of your taxable income, but the taxable interest is. Ordinary versus qualified dividends, taxed differently. So your ordinary dividends showing up over here. Taxable IRA distributions. IRAs, retirement accounts, right? Same pensions and annuities. They're a little bit different in the tax code. Same idea. All of these things adding to your taxable income. Now, Social Security benefits. This is a little bit of a wild one, and this might change in the go forward. We'll have to wait and see what happens with the new administration. But yes, part of your Social Security benefits can be taxable, believe it or not. Capital gains. Capital gains are kind of a separate beast, but it does show up here coming into your total income. And then kind of other income from Schedule 1. There you're going to find all sorts of stuff like maybe say like unemployment income, things like that. But all of these items kind of add up to what we call your total income, right? Now, if we take a look, there's adjustments. It says to go see Schedule 1, right? I guess we should pull up a Schedule 1 and see what that looks like. So you have an idea of these are going to be the things that can actually reduce your income. And again, we don't make things up on our taxes, right? We're doing them because they're legit the things to do. So let's take a look at Schedule 1, right? Additional income and adjustments. So remember I said unemployment compensation, more income you can have. There's also taxable refunds. That's for the folks that don't live in Florida. Florida, Texas. There's a couple of us lucky ones. We don't deal with these taxable refunds. Alimony, business income. There's a lot of stuff. There's so many things in here. They're not that common. That's why they kind of got moved to this other screen. But if we come down here, this is the real interesting part, is the adjustments to income. So these are going to literally be subtractions from your income, right? Educators' expense. This has stayed for our teachers. This has stayed on for a long time. It's not a lot, but it helps. So look at number 13, health savings account deductions. This is something that we talk to clients about quite frequently as far as how can we get ourselves into a better situation for taxes. Health savings account, otherwise known as HSAs, they actually, if you're contributing to one, will reduce your taxable income. So we love that. HSAs also become a retirement account if you don't use them for healthcare. So they're super cool. We really love those. Let me see. A deductible part of self-employment tax. If you're self-employed, if you're a 1099 contractor, part of your self-employment tax actually does reduce your income. So it helps a little bit, right? And this one we really, really love. Self-employed, SEP simple qualified plans. These are retirement plans. I will talk to a lot of potential clients and I'll say, hey, do you have a retirement plan set up? Because look at this right here, line 16. You can clearly see it is a reduction, an adjustment to income. It reduces your income and it puts away money for future year, which is great. Self-employed health insurance. If you work for yourself, if you're a 1099 contractor, that self-employed health insurance, and health insurance is not cheap, but that also can reduce your income. Alimony paid in certain situations, right? Student loan deductions. There's a bunch of things in here, but those main ones that we really love when we're trying to bring down our taxes are that self-employed, SEP simple, and other retirement plans, the health insurance, and the HSAs. So if we pop back over to our 1040, right? So that kind of walks us through those adjustments. And then after those adjustments, you're going to see adjusted gross income. Sometimes it's referred to as AGI, right? That's a number that you hear frequently because it's used in a lot of other things, a lot of other calculations you'll see. There's if we get down all the way to Schedule A, the itemized deductions, it's used sometimes there. But adjusted gross income, it's bolded for a reason. This just is a number that gets asked for a lot. Now, we've taken our income, we've subtracted out a bunch of adjustments, but I do want to say there are places where we can sneak in some deductions against our income. So, for example, let's see, what's a good way to talk about it? If you're looking at, I just got to find where they move stuff around a lot. Let's see, business income. Here we go. Oh, hold on, guys. I got to switch over to the right screen. Or the right panel here. If we're looking at the additional income piece, right? Additional income. See this business income or loss attached to Schedule C? If you're self-employed, if you're on a 1099, that is where you're going to put your little profit and loss from your business. It's going to have your income, but it's also going to list all of your expenses, right? So yes, this is additional income, but we can put more expenses, legitimate expenses, of course, on that Schedule C, and that will actually reduce your income. Same with line 5, rental income, right? If you have a rental property, you're not just reporting the rent, you're going to report all of your expenses as well. So you're actually reducing the amount of income that you're adding in here. You could take it a step further before you even get to your tax return. If you're looking at a partnership or an S corporation, it is so super important, and I say this all the time for my business owners, you have to make sure you're capturing all of your expenses because it's showing up right here. So there are expenses that are embedded into some of these numbers, and those are actually going to be what reduces your overall income. So back to the 1040. Yeah, so once we get to this AGI, next line 12, this is where we're looking at our standard deduction or itemizing. I know people always want to itemize. The reality is, I would say the majority of our clients at this point are taking the standard deduction because look at how high these standard deduction numbers are. if you're married and filing jointly, your standard deduction's almost $30,000. That's a lot of money. That's a huge amount of just a deduction for existing that the IRS is giving you. So now, if we have a little discussion here, do you take standard deduction or do you itemize? Well, you're only going to itemize if by itemizing your the total itemized deductions you have are more than the standard deduction. Otherwise, I don't really know why you would do it. I mean, unless there's a reason that you feel you have to. Marry file separate. That's sometimes the only time where you're going to end up itemizing when it doesn't work out in your favor. The reality is, if you're filing separately, you both have to do the same thing. You have to either both itemize or both take the standard. But unless you're dealing with some student loan repayments, usually most of my married families, they're usually filing together. And yeah, if you don't have more than like $30,000 of itemized deductions, you're probably just taking the standard deduction. Head of household, it's also super high, 21, almost 22,000. And even for single folks, unless you own your own home, it's hard. It's hard to beat this standard deduction. So we have our income. We subtract out our adjustments to income. Now we're subtracting out our deductions, whether standard or itemized. QBI, qualified business income deduction. Oof, that one is a complicated one to say the least. But if you have a business or something treated like a business, like some rental properties, you will have a number here that's going to further reduce your income while it exists. This one is one of those things that might go away next year. Don't know as of right now. I'm pretty sure it's set to sunset, but things are probably going to change after 2025 anyway. But regardless, then we get down to here, line 15, taxable income. So from line 1 of your W-2 all the way down to here with a little trip over to Schedule 1, you see there are so many places where if you've got something other than W-2 income, there are opportunities to lower your taxable income. And some of it is just understanding what flows where on a tax return and how those things work on a tax return. So, no, we blew through it a little bit quickly. Hopefully, you're getting some ideas of what you could potentially do to help keep bringing down that taxable income and, as a result, your taxes. But if you've got questions, if there's anything that you thought was really cool here that you wanted to learn more about, or you want to see like, oh, how can we use this in our own life, schedule a call with us. We do this all day, every day with clients. I find it fun. Actually, I love trying to help people figure out ways that they can lower their income and save lots of money, because at the end of the day, that's the fun part, right? You got to beat the IRS at their own game. And that's it for this video, and we will see you next time.